Good morning, dear students. This week we will learn further about uh, preparation of consolidated financial statements. As you already know, last week we prepared consolidated financial statements, or what we can say group accounts at the date of acquisition. But this week we will see how a company can prepare a consolidated financial statements after the date of acquisition. For example, after making some transactions, after doing some transactions, say company acquired another company, uh, say 6 months before, 1 year before, and then they did some transactions and made some profits or loss, whatever, and then they want to make another consolidated financial statement for the next year, and what uh, the financial statements will look like. So we will see those aspects in this chapter. The main purpose of this chapter is to prepare consolidated financial statements after a period of trading. This is what I just mentioned, and the specific aspects that we will cover in this lecture include um, explain uniform accounting policies, accounts for the pre and post acquisition profits of a subsidiary, eliminate intercompany balances and deal with reconciling items, accounts for unrealized profits on intercompany transactions, calculate group trading retained earnings, and then finally prepare consolidated statement of financial position. So we will be understood. So the chronology may differ, but we would be able to understand these aspects if we go through, if you understand the lecture. So in this exam, in this particular lecture, we will see two companies or two issues, say basically most importantly the pre and post acquisition profits or losses. And in this case, we will see the banned group, a group of company, assuming there have been no intergroup transactions. So we will assume there is no transaction between the group and the subsidiary. And then if there was pre or post acquisition profit, then how we can deal with those pre and or post acquisition profits or losses. And in the second example, we will see intercompany transactions. If there is transactions between the group and the subsidiaries, then uh, we will assume there have been intergroup transactions, and then how we can adjust other issues like unrealized profits and adjusting the balances and some other aspects in the group accounts. All right. So let's start with the first one. So in case of the band group, as we mentioned before, so 1st of January 2011, Band PLC acquired 80% of 10,000 £1 common shares in Stretch PLC. Investment in Stretch cost 12,000, retained earnings 4,000, fair value of the non-controlling interest at the date of acquisition was 2,950, and the fair value of non-current asset was 600 above the book value. So as I hope you understood all these situation, all these transactions of the balances, and all these balances are at the beginning day of the period, first day of the period. So if there is any profits or losses in this particular balance, in these balances between the group and the subsidiary, how we can adjust those. And we have to identify whether there is any profits or losses. And all these, as I mentioned before, are at the date of acquisition of the first day. All right, and then there is some we can see we will find some differences in the value. And I already mentioned here, the 600 is the above the book value, non-current asset above the book value. So there is some profit between 1st of January and end of the period. So how we can adjust these profits in the financial statements? So this is what the picture will look like after adjusting, and you can see, as you saw last week as well. So this is the individual parent company, this is individual subsidiary company, and this is the combined consolidated financial statements of the financial position um, at the end of the period. Okay, at the end of the period. And also, I'm reminding you again that we are assuming in this scenario that there is no transaction happened, trading happened between these two companies in this particular example. Right? There is no transactions or intercompany transaction between this, only acquisition happened. So if there is any profit or losses um, based on the asset values, um, then how we can adjust those. So some aspects are very easy to see. For example, the non-current asset, 26,000 for band, 12,000 for stretch. So but we can see the group account is 38,600. How it came out? It's easy. It's easy. So it's 26,000 and 12,000 is 38,000. And in this example, it was mentioned that the non-current assets, actually the fair value is actually 600 above. So that is this value actually increased 600. So 600 we need to add. All right, because the 600 increased here. So 38,600. What about goodwill? The total goodwill for the group. That means the goodwill of the parent and the subsidiary. In the subsidiary, or total of the parents. So of the parent company, and also the non-controlling interest. How much is the goodwill? So we have to calculate that. We will see it's in step 1. And investment is mentioned here in the information given. So 12,000 is the band's investment in stretch. So this is the asset account of the band. And current assets is 13,000 and 4,000 is 17,000. It's very simple. So yeah. And in case of equity, we know which part of the equity we should include in the group account is only the parent. So 16,000. All right, but there is some changes here that we need to find out. Retained earnings, okay, because of the profit changes, asset value changes. Obviously, there would be some change in the value of retained earnings. So we have to find out. We'll see it's in step 4. And non-controlling interest total we have to find out as well. All right, but the beginning non-controlling interest is given 2,950, and how it increased that we need to find out. All right, so let's see step 1 for goodwill. We need to find out the amount of goodwill. So as we know, how much the parent company's investment in the subsidiary is 12,000 is given. 12,000, and it's available here as well. So investment in subsidiary, and also given here as well. So investment in subsidiary 12,000. And how much share? What is the parent company is getting from the subsidiary? So they are getting 80% of the shares, right? So 80% of the shares is, so 10,000 is the fair value or the book value of the share. 80% is 8,000. And retained earnings pre-acquisition profit, actually the retained earnings before acquisition was 4,000 given. 1st of January given is 4,000. So 80% is 3,200. And the asset value increased. All right, the value increased 600. So out of this 600, parent company will get 80%. So it's 480. So altogether 11,680. But they gave more. Why they gave more? Because of the goodwill, as we know it. So what's the difference between these is actually goodwill for the parent company. 320 is the parent company's goodwill in the subsidiary. All right. And let's see, what about the non-controlling interest part? As we know, the non-controlling interest means the amount which has been invested by someone else in the subsidiary. So in someone else's investment, parent company invested 80%, someone else's investment is obviously 20%. So calculate similarly. Let's calculate similarly. So what is it? So it is 20% of 10,000, 20% of 6,000 non-controlling interests, retained earnings, and we are calculating this on 31st, remember, at the end of the period. All right, because we are preparing the financial statement at the end of the period. All right, so this is the retained earnings at the end of the period for the subsidiaries. So it is this, and the value increase, the non-current assets value increase 600. So out of this 600, 20% is for non-controlling interest. So this is what it is 3,320. But in the reported statements, what they reported is non-controlling interest in the subsidiaries is given here is 3,350. So what about this remaining 30 is the goodwill of the non-controlling interest in subsidiary. All right. So their asset is this, but they recognize this value higher. Okay. So why they are recognizing higher? Because the remaining value is for goodwill. So this 30 is the non-controlling interest goodwill, and this 320 is the goodwill of the parent in the subsidiary. So all together 320 plus 30, 350 is the total goodwill in the group. All right, hope it's clear. And now come to this is what we already got. So fair value of the non-controlling interest at the date of acquisition is actually 2,950, and 20% of the assets is this, and the remaining figure is actually goodwill. We can calculate this way as well. Yeah. So, and then we got the final the ending balance of the non-controlling interest. And total goodwill amount is 350. This is what we already shown there. And yeah, so now the aggregation of assets, there is some issue with the aggregation of asset. I already showed this one. So 26,000 is the parent company's non-current asset, 12,000 is the subsidiary's asset at the beginning, plus revaluation value increase 600. So 38,600, and plus goodwill for the parent company 350, and net asset for the parent and for the subsidiary total 17,000. So total assets altogether 55,950. This is from step 3. And finally is the consolidated capital and reserve for the group. And as we know, for the capital, we write only the parent company's one is 16,000 plus the retained earnings of the parent company. Okay. So in this case, only parent company's part should consider. And what's the retained earnings parts? from the ending balance of the retained earnings. So ending balance of retained earnings is 6,000, and in the subsidiary, and beginning was 4,000. So increase is 2,000, and 80% is of the parent company, 80% share. So 1,600 is the share of the parent company in subsidiary. So if you add this is the 36,600 is the ending balance of retained earnings of the parent company. And if you add these two together, and you will get this 52,600. Yeah, so we will discuss further the intercompany transactions and some other things in the next part of the video. Thank you for watching.